So thanks a lot to the organizer for inviting me, to Rama in particular. So the paper is co-authored with Iñaki Aldazoro, who is postdoc at SAFE, this excellent centers that we have in Frankfurt, which is the acronym for Sustainable Architecture for Finance in Europe, and with Domenico Deligatti. I mean, it's part of a broader project that I'm actually working also with various set of co-authors at Frankfurt Universities, looking at how to model in an optimizing frameworks banking networks, and to analyze the contagions and systemic risk in those networks, looking at situations in which effectively risk and default emerge endogenously because of a number of channels that we can think of being active in type of banking networks. So in fact, I mean, what we try to do, so normally the way networks have been widely used in other sciences is that, of course, most of the times the agents were not optimizing. So endogeneity related to the dynamic dimension of the networks. Here, as I said, one ingredient will be the fact that we think of banks as optimizing agents in a, I would say, fairly simple way. But the optimization and the endogenous price process will be such that we try to embed three types of channels for systemic risk, for risk contagion. And the three channels are network externalities. We think of those banks being linked to each other into interbank lending activities. So if there is banks have basically a portfolio decision, so they also decide to lend and borrow in the interbank market. And if they, if for some shocks they are unable to repay debt, of course, this transmits losses to other banks, and that's a sort of network externality. So as typically in network externalities, there might be positive network externalities in the moment in which we think that more interlinkages implies more liquidity and more insurance for those banks. But on the other side, beyond a certain point, if there are large shocks, more network externalities also implies negative externalities in terms of risk contagion. A second type of channel that we have is liquidity hoarding, because our banks are risk averse, and so whenever there is large uncertainty in this model, they tend to hoard liquidity. This is a second step channel in the moment in which there is cascading defaults, banks become very worried about this uncertainty. They start to do precautionary savings and they hoard liquidity. By hoarding liquidity, they make the cascading defaults even more severe. And last but not least, there are pecuniary externalities, because I will be more specific about this, but banks will also invest in non-liquid assets, and those will be subject to fire sales externalities in the moment in which there are large shocks. So we are considering this network, I would say, all the three main channels that are considered for risk contagions on the asset side of the banks. We have not yet embedded risk contagions on the deposit side, so let's say bank runs. But we want to assess what is the effect of these three channels on a number of things. The first one is whether our network can replicate a number of stylized facts of interbank networks. Second, we wish to measure systemic risk and systemic importance in this network. So I will show you, systemic risk, we measure it as it is commonly done in the literature now through Shapley value. But we also compare with other systemic importance measures. So we look at centrality, measures, input-output measures, metrics, and so on and so forth. And then, most importantly, we also try, given the fact that our model seems to capture many characteristics of banking networks, we also use it to assess the role of prudential policy. So we ask how systemic risk and systemic importance change whenever we change policies like capital and liquidity ratios. One important thing is that the systemic importance and systemic risk measures that we use, can be classified basically in two forms. There are ex ante measures, which again refer to a static situation of the network, say centrality measures or input-output metrics, and they don't take into account what would be, say, the situation of a stress test. So ex post, how the network would evolve after a series of shocks have hit. While on the other side, as I will explain more extensively later on, the Shapley value belongs more to the type of systemic risk measures that we call ex post. So they capture the situation, the evolving situation after a sort of crisis and endogenous default cascading have occurred in the model. So as I said, I mean, all of those channels are embedded are constructed because in a model we have banks which optimize, they choose borrowing and lending in the interbank market, they choose non-liquid assets. And we model markets in our model are basically done by two things. First, a price process, an endogenous price process, which we model through a sequential tâtonnement, which occur both in the interbank market and in the market for non-liquid assets, and a matching algorithm. So once the price has been determined in each market, we have to decide how to assign trading partners to each bank, and we do this through 3 different matching algorithms. So as I said, and we'll discuss about this matching algorithms in a moment. As I said, I mean, because of this apparatus, effectively 3 transmission channels arise. The network externalities, which I described already a little bit extensively before. So if there is any connection in terms of debt in the interbank market, if one bank is unable to repay debt, this transmits losses to other banks. Pecuniary externalities, which arise mainly because of 2 reasons. Those banks are, I mean, when they optimize, they are subject also to regulatory or VAR constraints, and whenever this is the case, and banks decide to sell assets in order to, because they have had the shocks, the elasticity of demand and the elasticity of supply in the market do not match with each other. So in this case, there is a drop in the price of asset, and if other banks have invested in the same asset, the value, there is an indirect transmission of losses, accounting losses through to other banks. And the third channels, which I said gets activated at a later stage, is the precautionary holdings, because those banks are risk averse. Or the variance of shocks matters for them. So if there is high uncertainty and default cascades, this induces them to hold liquidity. So whenever they decide how much liquidity to supply in the interbank market, they will supply less of this. And this is, I mean, this channel was actually also documented in other papers like Afonso and Shin. And if they do this, of course, this steepens even more the cascade, the debt defaults in cascade of debt defaults in the interbank market, because there is even less liquidity available in the market. Related literature, I mean, our paper is primarily related to the let's say high frequency payment systems like in Heisenberg and Noe. Which are based on, I mean, they model banks network through lattice theory. Cifuentes, Ferrucci, and Shin get closer, I mean, they are closer to our framework in the sense they also feature capital constraints and liquidity constraints, and they also have an endogenous price process, as we do. They only have it in the non-linear non-liquid asset markets. Then, I mean, in the paper which I quoted with Marcel Blum and Jan Kranen, we also looked at optimizing banks with fire sale externalities and interconnections. We didn't have the liquidity hoarding, and we were mainly focusing on the role of unconventional policy on systemic risk measured as Shapley value. One reason for having all those channels that I mentioned to you, all on the asset side, again, because one could also have crisis channels on the liability side, is the fact that some papers like Laserman and Young, but there's also paper by Doan Farmer and co-authors, have shown that actually only the interconnection channels, which is the one primarily featured by the other papers that I mentioned here, is actually not enough to explain why there are large banking panics, and effectively you need much more. You need all those channels all together in order to explain why there could be a large cascading default. There are specific things which are close to other papers. For instance, in the tâtonnement process, we use a central variation auctioneer. There are also possibilities of doing clearing in the interbank market through bargaining, bilateral bargaining. This pretty much depends on the countries. There are all type of institutions. We follow Duffy and Zhu in this, and we are modeling, as I said, market in which effectively there is a more of a centralized process. Once the price has been determined, we will have matching algorithms to determine the trading partners, and I will describe this in a minute, but we pretty much follow the Shapley and Shubik 72 papers for that, in particular for the closest matching algorithm. Systemic risk measure, as I said, now it's widely used in the theoretical literature, the Shapley values. In the empirical one, we have the Kova by Tobias and other people, but here we are trying to focus more on the theoretical side. Of course, there is also, I mean, it would be advisable to have a link between the empirical measures and the theoretical ones. Here we focus mainly on network measures, which again are very static, because you just look at the picture of the network and you measure centrality of different nodes or input-output type of metrics. And this more dynamic one, Shapley values, which are based on the configuration of the network ex post. So after the shock has occurred, how the new configuration determines the contribution of each bank to overall systemic risk. So as I said, I mean, there are, if I want to really highlight the contribution of this specific paper, there is, as you will see, we find out actually that risk-averse banking, so the liquidity hoarding, can capture like almost half of the systemic risk that emerges in this network. The fact that we have a convex optimization problem for banks also implies that banks more realistically, contrary to other banking network models, and more realistically, banks are both borrowers and lenders. So they can decide to be borrowers vis-a-vis a number of counterparties and lenders vis-a-vis a number of other counterparties. And this, together with the sum of the matching algorithm, also produces this associative behavior, which produces this core periphery structure, which is very much style artifact, which very much well known for banking networks. So we analyze three different matching algorithms. As I said, once the price, equilibrium price has been determined, each bank has its own optimal quantity that wants to trade, and we have to assign them. How we do that? We do with three algorithms. Of course, there can be more, but the idea is that each of these matching algorithms captures a different institutional reality. And the question of why we want to compare many of them is because we want to see whether different institutional setups might produce different stability properties or different effect of systemic risk. So we look at maximum entry. I will go and explain a little bit how they are done. Maximum entries is typically try to look at very dense networks, I mean, where basically all nodes have links with each other. Closest matching, so we think of pairing together banks that want to trade a certain quantity with banks that have a similar type of quantity, desired quantity in terms of trading, in terms of size. And then random matching. This is really like a type of random search and matching framework. And as I said, another contribution of the paper is the fact that we look both at Shapley values and we compare those with other systemic importance measures which are more of a static nature. And actually, if I have to think of the type of stress tests that are currently conducted, I would say that they are more like a type of ex ante stress test, in the sense that they pick a scenario and they look at what is the effect in that scenario of I mean, in terms of risk, but they don't think of an evolving pictures in terms of a random allocation of shocks. So the results is, so we have some positive results and some negative results. So first of all, our network generally, given this type of matching algorithms that we use, tends to replicate, I mean, we check that our network is realistic. So our network, we check that is able to replicate a general core periphery structure, and under more or less all matching algorithms has low density, show low density, which is typical of banking networks. There are also, we compute also other things, betweeners, clusters. I will show you the numbers, but this is the main message. Second, we see that systemic risk measured by Shapley value is positive associated to non-liquid assets, and this is quite intuitive because the higher is the amount of investment in non-liquid asset, the higher is the extent of pecuniary externalities, so the more fire sale there are and the higher is the transmission of indirect losses to other banks. So more investment in non-liquid assets means more transmission to fire sale externalities, but it also means more interbank borrowing, because typically the banks that invest more in non-liquid assets, they are also more leveraged. So there is also more transmission of network externalities. So generally speaking, those two balance sheet indicators tend to predict that there is higher systemic risk. When we look at systemic importance measures, we find more of a negative result in the sense that they deliver quite inconsistent ranking with each other. So this is something that the regulator must be worried, because they actually don't deliver the same ranking. So one has to make a decision or reflection about which of this systemic importance measure is more appropriate in terms of identifying banks that are risky or possible spreaders of risk. In expectation, we find that the type of matching algorithm, so I told you that the matching algorithm, maximum entry as opposed to maximum entropy, as opposed to closest possible matching, captures the institutional environment. So there are markets in which trading is more random, because maybe banks are subject to highly to liquidity shocks, so they tend to meet more randomly. There are markets in which there are banks tend to cluster more, so like large banks tend to trade with large banks, and those will resemble our closest distance matching algorithms. So, however, what we find is that the different matching algorithms do not affect very much systemic risk. So institutional characteristics of the trading mechanism are not fundamental for this. On the other side, for instance, we find that the transmission channels might be very important, and in particular that liquidity hoarding is very important for systemic risk, and fire sale externalities. And it probably interconnection in the interbank market are the ones that account the least for the transmission of systemic risk. And then in terms of policy, we find that higher liquidity requirements tend to, of course, to reduce systemic risk. Here I'm talking, when I say systemic risk, I mean Shapley value, but they also produce lower investment. So if we think of a trade-off from the point of view of a prudential regulator between efficiency, so let's say aggregate investment and risk, we find that in this case the trade-off is pretty bad, because it lowers risk, but it also lowers investment. On the other side, and I will give you an intuition for that, a higher equity requirement tend to lower risk, but they don't lower too much investment. The main reason for this is the fact that when we increase the liquidity requirement, this also means for the banks an asset substitution. So they reduce investment in non-liquid assets because they have to keep a lot of liquidity, and they invest much more in lending to other banks. So this increases the extent of network externalities, but reduces investment. On the other side, under higher equity requirements, banks do not reduce very much investment in non-liquid assets. Now let me go to the model. There is a network of n banks, and it's a directed network. So GIJ represents the cross-borrowing and lending in the interbank market. And of course, banks decide how much exposure to hold. Notice that actually in this model, deciding how much you want to borrow and lend also implies that you decide your partners, because in the moment in which you are assigned based, for instance, on closest distance, if you decide how much you want to borrow, you are actually also choosing the partners. Banks, as I said, they have a concave utility, and profits depend on the return on non-liquid assets, which is the first term. They also lend into the interbank market, so there is a return from lending, and then they borrow, and here we assume that they have to pay a premium which depends on the default probability, and the parameter xi is calibrated according to loss given default. Because this is a nonlinear setup, and there's also stochastic setups, because the simulation we will subject banks to a multinomial distribution of shocks. We will take also a second order approximation of this, from which it is quite clear that the variance of non-liquid assets, of the shocks to non-liquid assets, and the variance from the default probability in the interbank market, which is actually, the default probability is endogenous in our model, matter pretty much for the bank's decision. Banks have to decide, cash and deposits, which we have also in the balance sheet of banks C and D, are exogenous for the moment. I will tell you in the end that we have a development of this paper in which we are trying to introduce a global game for the determination of deposits, so that we also have risk channels on the liability side. But other than that, at the moment, the balance sheet of banks, cash and deposits are exogenous, and then there is banks have to choose no liquid asset and they have to choose how much they want to lend vis-a-vis each counterparty, and how much they want to borrow, and then of course they have equities. And the maximization problem is subject to two constraints. The first one is a standard liquidity constraint, and the second one is an equity requirement, like equity over asset. Wn and Wl are the risk weights, which we parameterize according to policy parameters. Gamma is the regulatory requirement for equity requirements, and tau is a capital buffer that banks decide to have on top of the equity requirement. So banks choose all those assets, so no liquid assets, lending and borrowing, to maximize this utility, subject to those constraints. The maximization problem for each of these banks, let me tell you that those banks are also heterogeneous, because we assume that there is a uniform distribution for the returns on all liquid assets, so they all come up with the different decisions. This is very important, because otherwise in a network they wouldn't get to trade. If they all come up with the same decisions, there wouldn't be scope for trading. So after the optimization, each bank comes up with a borrowing, with the demand for borrowing and lending. So they go to the Varangian auctioneer, they presented their borrowing and lending, and the Varangian auctioneer aggregates together the borrowing and the lending. And then if, of course, the borrow, and here the atonement process starts in the interbank market, because if the borrowing is larger than the lending, of course, the interest rate in the interbank market will go up, and the opposite is true if the demand for borrowing is lower than the supply of lending. Of course, as you know, atonement has a fictitious time, so every time that the Varangian auctioneer changes the price, the banks will not trade, they will just re-optimize according to the new price. The Varangian auctioneer will collect again the demand and supply, will come up with the new excess demand, and will adjust the price again. At the end of the process, so that when the price has been determined, and here there is a unique price, of course there will be an equilibrium price, but there will be also vectors, because at that price we will determine how much each bank wants to lend and borrow. So we will have a vector of optimal equilibrium lending and borrowing. At this point we have a price, and we have how much each bank wants to borrow and lend, but we have to match partners, okay? And we do it in three ways, comparing those three ways. One is the maximum entropy, which just tries to distribute lending and borrowing as evenly as possible. So we start with actually a guess which comes from the actual data of cross borrowing and lending in the interbank market, but then we have this algorithm that updates our initial guess and makes this distribution as evenly as possible. The second algorithm that we use is the closest matching. So what we do here is that we rank banks according to the highest borrowing and the highest borrowing, and then the lowest borrowing, and from the highest lending to the lowest lending, and then we start to match them. And of course, if the process doesn't clear immediately, we do a second round of matching according to the size of the borrowing and lending. And then there is the random matching with this loading factor, which is, here again, the economic intuition is that we are thinking of a market in which there are a lot of liquidity shocks. So very often, even if banks would have a rational, economic rationale to pair with each other, they receive very often liquidity shocks, so they have to rematch with other type of banks. So this is what this third matching algorithm is supposed to capture. One thing that you will see, there are many results in the paper about all the synthetic network measures that those three matching algorithms deliver, cluster, density, betweenness, but the main result about this is that actually, as it is quite intuitive, the first matching algorithm delivers high density because it's very even, so it delivers kind of complete network in the sense of Allen and Gale. The second one, closest matching, delivers the lowest density because there really you pair banks according to their size, and the third one delivers a density which is in between of the two. The atonement process, which I describe, of course, is related to occurs in the interbank market, but there is also an equilibrium and an atonement process in the market for non-liquid asset. And on this front, we borrow entirely from Cifuentes, Ferrucci, and Chin. So we assume that there is a sort of, there is this exogenous, there is this demand functions. So we collect, we aggregate our supply of assets, of non-liquid assets in the market, which is our SP function. and we say, well, we start from a situation in which there is equilibrium, so the price is at 1. Imagine that one bank is hit by a shock. Because of this shock, the bank cannot meet anymore the capital requirement, the equity requirement, so it must sell assets on the market. And again, because I told you that whenever there is a constraint, the elasticity of demand and supplies in the market will not match, so this will trigger basically changes in prices. In the moment in which the change in price affect the balance sheet of other banks who have invested in the same asset, those banks will also be unable to meet the equity requirement, so they will start to sell assets on the market themselves. So, I mean, at the first shock, there is a supply, but we can also, given this demand function, find a price, a bid price for that same quantity. We work out a type of atonement process, as it is described also in Mascolel. So we take the mid price between this, and we go and look at the new supply of non-liquid asset. At that price, there will still be a disequilibrium, but this equilibrium will be reabsorbed until we converge. I mean, the convergence is guaranteed by the shape of this function, of course. This can be found in Mascolel. The very important thing of this is that, of course, this really captures the change, I mean, really the essence of the changes in the balance sheet values every time that the price change. So it's really a way of modeling the fire sale externality step by step, because every time you see the change in the balance sheet of the banks. Before closing the model's details, I'm going to tell you a little bit about the systemic importance and systemic risk measures that we are comparing. Okay, I think I'm now we can slow down a little bit. So the systemic importance measure that we look at are essentially of two types. So standard network centrality measures. So there is this degree in and out, closeness, betweenness, eigenvectors. I mean, I could go into details into one of them if there is an interest, if there are some questions about this. But effectively, they all captures the idea that there are maybe some central nodes which might be bigger spreaders of risk if you happen to trade with those nodes, or maybe they are related to the distance of among different nodes. So, for instance, if there are, if the betweenness coefficient is very small, that means that there is very little distance between nodes. That means that there are some banks which are acting as gatekeepers among different nodes. Okay, so actually we really have a battery of computations here, but I will summarize what are the main results here. Then we compare these input-output based measures. I mean, because one of the co-authors, Iñaki, has been doing a paper with Ignacio on this input-output based measures, where the idea was just, you pick the data of the cross exposures, and then you come up with using the type of structure that is in the Leontief input-output measure. You come up with these coefficients. And the third one is this ex post measure, as I said, which is the Shapley value, and this is by now widely used in the literature. The idea of the Shapley value comes from both cooperative and non-cooperative game theory. So you basically ask yourself, what is the contribution of each bank to an aggregate value? In this case, the aggregate value is is aggregate default. So we measure aggregate default by summing up the assets of all the banks that default. We define a bank as defaulting when, even after selling all the non-liquid assets, it is still unable to meet the equity requirement. So that's effectively dead. Until they cannot meet the capital requirement, but they can sell assets, they are illiquid. But once they don't have any more assets and they cannot meet the capital requirement, they are completely dead. So we sum up the assets of the defaulting banks at the very final stage of the shock process, divided the total assets. And the Shapley value is, this was originally created for like unions and cooperative game theory, basically asked having different permutations of those banks. So you have different positions and you assign those banks in different positions. So you calculate all the possible permutations in which one specific bank is in. And then and you compute for those permutations the aggregate default. And then you compute the aggregate default for all the permutations in which that specific bank is out. given the difference between these two, then you basically say what is the contribution of that specific bank to the aggregate probability of default. I mean, I think I mentioned before in the related literature, but this was used initially by Borio and Tarashev, so we're just borrowing from the literature on that. So I think I can briefly comment on the calibrations of the parameters. I mean, of course, you know, to compute those things, you need some simulations. So and you need to assign calibration. So we try to be as close as possible to the data. We have a number of banks around 20. I mean, this basically, there is a paper by Dreman and Tarashev that talks about, you know, what is the general size of a regular banking system. The liquidity ratio alpha is set according to the cash reserve in the United States. Then there are the regulatory parameters, the risk weight on non-liquid asset, the risk weight on interbank lending, which are basically set according to Basel III. The equity requirement ratio as well, it's basically set according to Basel capital requirements. We look at, I mean, we introduce also this desired equity buffer, which at the moment I don't remember where we picked this number, but we must have picked it somewhere. And then we take, for the bank deposits, we look at the bank scope, Bureau van Dijk bank scope, and we look at the top 20 euro area banks, and we average basically their bank deposits. The same is for bank equities. We set bank risk aversion equal to 2. That's, I mean, you know, it's in every literature, micro, there is discussion about what is the risk aversion parameter. There are a number of reasons to choose 2. We try to look at indirect evidence, so what is the parameter that generates the most significant transmission, or the most closer to reality transmission of defaults. Then we have this loss given parameters, which determines the premium on borrowing, and this is also set according to data of large banks. And then there are the shocks. So, I mean, as I said, banks are heterogeneous because they have different returns on non-liquid assets. This is very important because, as I said, scope for trading effectively arises because those banks have different portfolio. They come up with different portfolio optimization. In particular, the banks which have the highest return on non-liquid assets are really the ones that want to invest heavily on non-liquid assets. So in the end, they will be big, and they will also be the ones that are leveraging a lot. So they are, because they really have good investment opportunity, they are willing to go onto the interbank market and borrow a lot. So think of Deutsche Bank. So Deutsche Bank is really willing to borrow a lot and invest a lot because they have good investment opportunity, or they are maybe diversifying. So we have a distribution on the return on non-liquid assets, which is a uniform with the parameters that you see there. And then there is the shocks, is really like the more this kind of stress test ideal thing. I mean, we shock the value of non-liquid assets, and we do that through a multinomial distribution that can capture also the fact that those shocks can be correlated across banks, and then of course all of the banks can be hit by the shock. So the cascading defaults do not only occur because one bank is hit by the shock and then it doesn't repay debt, but it also comes from the fact in a simulation that more banks can be hit by a shock. Okay, here I just briefly tell you about those network metrics. So we have so here let me show you first, there is a baseline network configuration. So even before we simulate the shock, of course we can solve for our network in the sense that each bank optimally solves for the exposure, and then we can solve for the price, for the tatonement process, for the equilibrium price, and given this, we come up with a certain configuration of the network, which of course is different depending on whether we have a closest matching algorithm, closest distance matching algorithm, or a maximum entropy. And I mean, here we picked only 2 examples. I mean, of course, it is quite intuitive that if we use the maximum entropy, it looks quite dense, okay? Well, if we take the closest matching, it's more sparse. Now, here are the data for the baseline network configuration. Here are the data for the RMA is random matching, CMA is closest matching, so you just match the banks with the closest size in terms of borrowing and lending, and then the maximum entropy. Now, look, the density, it's quite different, but so 52 is very close to the density that is computed by Alves et al. For the whole network of the European banks. So if you take a large network, the density is quite high because there are many, many connections. So that algorithm will be captured the entire, let's say, European network. The CMA, the closest matching, is actually captures much better the network at national level. So there is a paper, I don't remember the authors now, that look at Dutch data, and they find a number which is very close to the one that we find for the closest matching algorithm. And of course the random matching, here the random matching depends on this loading parameter, so we can change this loading parameters, but of course we get a density which is between the two. All the other, I don't have time to go all over them, but let me tell you that the clustering coefficient is low, and that's correct. That's how it should be. And generally speaking, some of this tell you that there is this associative behavior, which is also a key feature of banking networks. Now, let me tell you about contribution to systemic risk. So now we shock the model, and that's the results that we get. We focus primarily here on Shapley value, but I tell you briefly also about the systemic importance indicators. So in this picture, what we show you is that the Shapley value, so the contribution of each bank, here we have 20 banks, the contribution of each bank to the Shapley value in the three different matching algorithms. As you can see, I told you at the beginning, the matching mechanism doesn't matter very much. Now, one possibility is that actually those three matching mechanisms are not very different from each other. The second possibility is that actually the trading institutional environment is not so crucial for the transmission of risk. And that's one of the questions that prudential regulators were having. Shall we reform something? Well, it doesn't seem that it says that institutional environment will matter very much. What matters much more instead, as I told you before, is the balance sheet characteristics of the banks, because you have to match what you see here with the table that we have in the paper that was too big to put in the slides, in which we have the balance sheet characteristics of the banks. And what I can tell you is that what you see is that the banks that contribute the most to systemic risk are the ones that have the highest non-liquid asset ratio over total asset. So the banks that get a lot of fire sale externalities or transmit a lot of fire sale externalities, and the banks that are highly exposed on interbank lending. And actually the two are correlated, because as I told you before, banks that have very good investment opportunity on non-liquid assets, they also tend to leverage a lot. So they are both exposed heavily to fire sale externalities and interconnection externalities, and given that they are risk averse, they also tend to hold a lot of liquidity when and they are big. So if they hold liquidity, they create a lot of problems. So here indeed what we see here, we show you how the Shapley value changes with respect to a number of balance sheets characteristics. Not with all of them there is a clear association, but with one in particular there is a clear association, which is with the total asset. So again, this goes back to the idea that the more banks are exposed in interbank lending, and the more banks are exposed in non-liquid assets, the more they transmit risk. I really don't have time to comment on this input-output measures and on the other systemic importance measures, but only two things I can tell you. The main result that we get is actually a negative result, which is the fact that all those systemic risk measures do not deliver consistent results, particularly with the Shapley value. So this basically calls for a reflection that we really have to think carefully about which type of systemic importance or systemic risk measure we pick, because they deliver completely different results. So it will be, we don't find two measures that really tend to deliver similar results. Okay, and now here the last set of exercises that we do, as I told you before, we look at the effect of prudential regulations in this network. In particular, we change the parameter on the capital ratio and on the liquidity ratio. Alpha is the parameter on the liquidity ratio, and gamma is the parameter on the capital ratio. Generally speaking, we see that across all the three matching algorithms, systemic risk declines when we increase the prudential regulated parameters. We see a lot of bumpiness in the decline of systemic risk for with respect to the liquidity ratio that mainly comes from the risk-averse version of the banks and the liquidity ordering. Indeed, in the paper, there is an appendix where we show that if we take out risk aversion, then it declines smoothly. So this non-linearity produces the bumpiness, and we also show that it basically jumps up of another 50%, systemic risk jumps up of another 50% in the moment in which we put risk-averse banks. Now, one thing that we want to assess, the very last thing we want to assess is the trade-off between risk and efficiency, where efficiency here is only measured by aggregate investment because we don't have a full-fledged macro model with welfare. So the question is, if we increase one of those parameters, systemic risk declines. But what is the effect on investment? Investment in all liquid assets, because effectively there is a trade-off for the prudential regulator, because if it increases the capital requirement, it might kill investment while reduces systemic risk. So then we ask, for both of those parameters, what is the effect on investment? And what we find, so what we find is that generally speaking, the decline in investment, so this is, I can't see very well, this is the alpha, so this is the liquidity requirement and this is the gamma. So the decline in investment is actually in the end much bigger for the liquidity requirement, and the reason is the following. So when there is an increase in the liquidity requirement, banks they want to invest less in non-liquid assets, but they also wish to borrow more because there is really tight liquidity. So the demand for liquidity in the interbank market goes up, and in fact you see here that the equilibrium interbank rate goes up. Now when the interbank rate goes up, there is an asset substitution in the sense that for those banks it's no longer convenient to invest in non-liquid assets because maybe the return on non-liquid asset goes below the return on interbank lending, which goes up. So it's more convenient to lend to other banks because the interbank lending has gone up, and maybe it has gone above the return on non-liquid assets. So what happens with an increase in the liquidity requirement is that many banks start to sell non-liquid assets because it's more convenient to use liquidity for lending to other banks. So there is this sort of asset substitution. The result of this is that the decline in non-liquid assets under the increase of the liquidity parameter is much larger than the decline in non-liquid assets under the increase of the capital ratios. This whole picture just make the story consistent with what I told you here.
So what's alpha and gamma in this?
Alpha is, I defined it in the slides before, alpha is the parameter on the liquidity ratio, and gamma is the parameter on the equity ratio. If you remember. Sorry?
So
they both increase. So if you remember, I defined it here. Yeah, after so many slides. So the idea is, look, if you increase the liquidity parameters, banks start to want to go more on the interbank market to lend, and this basically implies that you reduce systemic risk, but you kill also investment in non-liquid asset. While if you increase the capital ratios, there is more balance between interbank lending and non-liquid assets. So the policy trade-off between risk and efficiency is less steep if you increase the parameter, the equity ratio parameter. Let me just conclude. In the paper, as I said, it's actually, because this was a broader project, in the paper you will find also a lot of tables comparing many of those networks coefficients. So there is a lot of descriptions about the network topology and the effects on systemic risk and so on and so forth. The idea was to have a micro-founded model with optimizing banks and the number of channels on the asset sides to account for systemic risk. And if this delivers a realistic network, as it does to us because of a number of synthetic indicators that match with reality, then we looked at prudential policy in terms of equity and liquidity requirement. As I said, because this is a broader project, now there is the follow-up will be that because crises happen to be there for many channels, fire sale externalities, interconnections, and of course liquidity ordering, but there is a lot also of runs on short-term liabilities, and this is not in here. So we have a version of this model where we are introducing, where here the deposit is completely exogenous, but we are modeling the deposits in two ways. One is as a standard global games type of model, let's say Diamond and Didvik development toward the Carlson Van Damme, and the other one is the type of bank run that I've been modeling in the paper with Ignazio Angeloni in drawing up from the Diamond and Rajan type of informational based bank runs. So we try to get an elegant type of setup for this bank run and introduce that so that in the end we can do a kind of variance decomposition and tell you whether the systemic risk comes from contagion channels on the asset side or from contagion channels on the liability side. I hope I was on time.
Yeah, I'm wondering, I would have guessed that in some models that if you increase the capital requirements, that the cost would be that there'd be less liquidity creation. It sounds like your other model may address that, but I'm not sure. I'd just like you to comment on whether, it seems like that's not in the model here, the value of liquidity creation. It's just the value of risky lending.
The value for liquidity creation, did I understand correctly?
Well, I come from Diamond Didvik, so I think in those terms.
So there is no, the short-term, the liability side here is completely exogenous. That's what
It's exogenous. When you make it endogenous, it does.
Yes, is there
a role for liquidity?
That's what I said, that we are developing exactly those days. We are in one version of the model, we created a type of threshold for the deposit, which really looks like a Morris and Chin, Carlson and Van Damme type of threshold for global gain. So assuming that bank runs comes from liquidity shocks to depositors, that's one possibility. I personally don't believe very much that bank runs comes just because depositors become crazy, but it could be that banks start to withdraw liquidity or withdraw deposits, but I don't believe very much that there are liquidity shocks on depositors. And the other possibility that we follow is, as I said before, this informational based bank run. So there is still a threshold that determines deposits, that is determined by the fact that the return on deposits falls below the return on assets. Now here, the return on asset is random, is stochastic. So you need to have, basically here you need to have some information that tells the depositors that there should be a signal telling you giving you information about the return on assets on the bank.
Okay, I would have guessed that in that setting that there's an additional cost of the capital requirement that comes from reduction in liquidity provision. Is that what you find?
We haven't got yet at simulations there. We're just working out the changes in the model. But yes, I pretty much presume that, as I said, there are many contagion channels. We cannot expect that crises only come from one contagion channel. In this paper, we focused on all that we believe being the contagion channel on the asset side. But there are definitely also contagion channel on the liability side. I think in the end, what it would be interesting for us to do is to do, I call it variance decomposition, but say take systemic risk, here are the channels, and tell me how much of the systemic risk come from each channel. That's what eventually one would like to do. Also because there is a discussion in the literature about so there was at the beginning very much discussion of people saying that the interconnection channel was more important than the fire sale externality channel, and vice versa. What we find here is that interconnection account for much less than fire sale and liquidity hoarding.
Okay, it's like a performance attribution.
Sorry?
Performance attribution.
Yeah. But of course, much of this can also depend on parameters, but as I said, we made the effort to be as close as possible to data. And there is confidence bands in the systemic risk. There is 95% confidence bands. So, there are a lot of robustness checks for which we are confident enough to say that the results are robust. Yeah.
That at least for the Austrian banking system, I can more or less confirm. We investigated some similar channels, and pure network contagion effects are way out shown by other network effects. I think what's lacking is a sort of idea of common exposures, which I think is you have one non-liquid asset, so that probably is the common exposure, but that really also drives the issues. I have one question about the clearing price. Our stylized facts would say that the capitalization or the expected return of a bank also drives a risk premium on the interbank rate.
Mm-hmm.
So how would that affect the return?
So, I mean, I think that what you say is captured by what? So this premium here. So at the moment you don't see it here, in the sense that this risk premium is equal. I mean, so the only difference here is that we calibrate differently default probabilities, and the default probabilities are basically averages on the baseline network configuration. So those premium are heterogeneous in the sense that let me put it this way, if you know that in the past one bank on average defaulted the most, more than others, then you charge a higher premium. But the loss given default is calibrated equally. So it's only partly captured. I think that's what you meant, that you are paying different prices if you are if you are borrowing and if you are different banks. So if you had some default probability in the past, if that is higher, then you might need to pay more. But I must say it's very stylized as it is done here, because I think there should be a sort of Bayesian learning process. Maybe if one is able to embed it in the dynamic process of the shock, that every time this probability of default gets updated, so that you learn what is the previous probability of default. The second thing that I want to say on this is that again, it depends very much on the type of clearing that there is in the interbank market, in the sense that here we are assuming that there is a central variation auctioneer, so that the general let's say the risk-free interest rate is determined by the variation auctioneer, and then on top of that there is the premium, which is different for every bank and only depends on the probability of default. But you can imagine a completely different institutional setup in which those banks are bargaining with each other. So you don't have the central clearing atonement, and you have a bargaining process. In that case, both the risk-free rate and the premium will be completely heterogeneous across banks, because every bank is just talking on the phone. But this very much depends on the market that you're considering.
Sorry, one question here and
then. Maybe you could clarify. So you have interbank contagion, which is modeled by the matrix G, if I understand correctly, and then could you maybe highlight?
The matrix G is the cross exposure in the interbank market. This is
exactly. Could you highlight how you model the portfolio exposures and the fire sales in comparison to the matrix G and the contagion via fire sales?
Yeah. So the bank in general, every bank at time 0. This is fictitious time, but time 0, every bank chooses N, L, and B. Okay, every bank. And they are all choosing different N, L, and B, because they have different return on a liquid asset. So if you are a bank that has a very good investment opportunity, you choose a high N and probably a high B, because you want to leverage, and a low L. Okay? Then you go to the variation auctioneer. Every bank goes to the variation auctioneer. The variation auctioneer sums up all the borrowing and all the now we're talking about the matrix G, how to determine the matrix. So they go and the variation auctioneer sums up, and then by clearing this aggregate supply and demand comes up with the price. Now given this price, we ask the bank to reoptimize again. So every time that there is a change in the price, the bank reoptimize always. Okay, so in the end, what the bank wants to borrow or lend vis-a-vis all the other parties is always coming out from the portfolio optimization. On top of that, there should be also the matching with the pairs. Okay, so if I want to borrow 10 or I want to lend 5, I might need to borrow from Tobias, from Laurent, and I mean, depends on how you match pairs, and that depends on the 3 matching algorithms. So the optimality plus the matching algorithm determines G. Regarding the non-liquid asset, the optimal amount is determined here, but the tatonement is determined through that process that I described here. Now, the 2 tatonement processes are separate because in history nobody could solve the tatonement. I mean, this is a problem that dates back to Barra. Nobody could solve the tatonement contemporaneously in 2 markets. What it means is that when you solve the tatonement in one market, you take the price of the other market as given. Okay? You could imagine that they instantaneously change all the time. But this is a very old problem. And now, what I mean in Mascolel they describe is that there are a number of assumptions that make you believe that if you do sequential tatonement, that is correct, meaning that you start with one market, taking the price of the other market as given, and then when you go to the other market, you take the price of the equilibrium price of the first market as given. And if you think of a sort of fixed point between the 2, then that should converge in theory, but we haven't proved it, and I don't think anybody proved it. You should converge after a fixed point argument to a complete instantaneous endogenous tatonement between the 2.
And how many liquid and how many illiquid assets?
So liquid is only cash and deposits, and it's exogenous. So really the optimization, the primitivization process is only, they are choosing borrowing, lending, and no liquid assets. But the liquid assets, that's the same question that he was asking before. So we shut off all the channels on the liquid asset side. Because, I mean, those models are quite complicated, so you need to build one piece at a time. Otherwise, you have 5 channels, you really don't know where things are coming from. So you have to add one channel at a time, really.
I'm confused about the borrowing and lending rates are different.
Yeah.
So who gets the difference?
Yeah. It's in aggregate they square with each other. So there are some banks who default.
So I'm confused about this. You have banks lending and borrowing. That all nets out. So the total amount of wealth the banks have should be invested
We have a proof.
in the illiquid assets. So I don't understand why it's...
On average, there are some banks that are defaulting and some banks that do not default. So of course, on average, they have to square with each other. What you get on the lending has to be consistent with what you pay on the borrowing, but in aggregate. What I showed you is the problem of one individual bank. So yeah, many people get confused with this. One thing is the total, and the other thing is the individual one. The individual one, they can be different. Of course, they can be different.
But
at the aggregate,
their expected payout is the same. Their expected payout is RL.
so there is another.
rate they pay.
This is another issue. How the premium is consistent with an arbitrage condition. So even there, in the paper we derive and show you that suppose that there is no default, then you have a lending rate which is basically does not include any premium, okay? And then in that case, the lending and the borrowing are just consistent with each other. If there is default, you apply different premium depending on the default. But the different premium shall be such that if you take an average between all the banks that default plus all the banks that do not default, in arbitrage, that should give you the same return that if you do lending to never defaulting banks, and if you do borrowing. That has to be consistent through arbitrage conditions which are imposed, and in fact, this is basically, this expression here is the reduced form that we get after solving this arbitrage in the aggregate.
So I think one of the conclusions you insist on is this: you compare liquidity ratios and capital ratios, the relative impact. This is a very interesting question. But to do that, you need to really make sure that the link between liquidity and solvency is well captured in the model. So here they determine the cash holdings in the beginning.
Yes.
And then...
Oh, it's fully exogenous, yeah.
Yeah. But then,
Yeah.
if you think about it, so the way the liquidity failures, I mean the bank illiquidity events, cases where banks default due to illiquidity, is really linked to the solvency of the same banks
Yes.
because the perception of insolvency is what
Correct.
triggers, funding to be.
Yes.
That means that somehow the level of cash they hold should be concerned with this because they can't just hold zero cash and or hold a lot of cash and be insolvent. So this is, I think, not entirely in the model. Maybe that's why you find that the capital regulation or level of equity is not so important
Yeah.
because otherwise the banks, if you embed this concern somewhere in the model, the banks would hold, independently of their portfolio choice here, they would have an incentive to hold capital to maintain their funding
Yes.
because otherwise their funding gets cut down.
Completely agreed. That's, I mean, follow up also from the previous comments of two different people. Yes, the liquidity, so let me put it this way. It's always difficult to define liquidity, but liquidity on the liability side here is completely inexistent, so I agree with you. I think your point is very valid, that here there is a very strong connection between liquidity and solvency. In the sense that what is liquidity is simply the fact that you don't have enough money you have a shock and you don't have enough money to fulfill a capital.
Let me just specify more what I'm saying. I think liquidity here is defined in terms of their cash holdings. But I think that's not really the perspective of the liquidity regulation because a bank's liquidity is more tied to its capacity of raising cash when needed. It can hold very little cash right now, but when there's a liquidity shock, if it can raise the funding needed to face this liquidity shock, then it's fine. And that's really about solvency because that's on the basis of its assets, it's going to either get a loan or do a repo and so on. So I think at the end, it's really an issue of solvency. That's why it's so important to look at solvency and capital regulation. And I think as liquidity as a symptom, and where there's disagreement about this, there are books which say the opposite. But I think that it's because liquidity should be interpreted as the capacity of replacing
I agree.
than what I have now.
I agree. As I said, I cannot go and speak much about this precisely because, as I said, this cash holdings are really exogenous in this model. So there are so many channels that are shut off. But I agree with you. Probably what you said at last is also that it's not only a matter of adding some types of contagions on the liability side, as I was suggesting, like sort of bank runs, but it's also probably one has to think about how to better model the liquidity requirement, because as you say, it's not only simply raising the size of cash, but it's also the potential of raising cash in face of shocks. So probably one has to work out also something there. It's not in the model at the moment, but it can be developed. Yeah.
Thank you. I have some question, but I'll ask you. We're a bit over time now, so I think we can just go to the wine reception. Yes. So thank you everybody for coming.
Thanks a lot.